everybody. My name is Lawrence Gosling, and I'm the host of The Advisor Hour. I'm sure you know that because many of you watch it on a regular basis, and thank you very much for doing so. And today I'm joined by one of our guests from a recent show, and that's Glen Stewart from Committed Capital. Very lovely to see you again.
Good morning, Lawrence. Thank you very much for having me again.
Oh, pleasure. No, I enjoyed having you on the programme. So this is kind of one of the longer interviews that I think we mentioned to the audience at the time that we would be doing. Just let's sort of start really at the kind of the beginning for advisors and who are not too familiar with sort of Committed Capital. I mean, the firm actually has got a good long heritage. Just give us a little bit of the sort of the history of the business and some of the kind of the highlights, things that you're all very proud of.
So we're specialists in growth stage venture capital and have been investing for a little over 2 decades now in UK-based high-growth tech companies across the UK, so regionally agnostic. Our mission since 2001 has been to support post-revenue investee companies through applying and sharing the expertise of our team that our team has of founding, building and exiting those companies. From an investor perspective, we offer an opportunity to invest in a portfolio typically of between 8 to 12 actively managed growth stage tech companies, whilst benefiting from the various EIS tax reliefs available. From an investee company perspective, we're very hands-on and proactive investors. And in addition to providing growth funding, we sit on the boards of companies and actively support and engage with them in areas such as corporate governance, marketing and sales strategies, financial modelling, and making strategic B2B introductions. And certainly the pandemic has really highlighted the importance of sitting on boards to help those companies overcome unexpected financial and strategic obstacles. Where companies continue to meet KPIs, revenues, and sales targets, and where the investment thesis remains correct, we provide follow-on funding to facilitate growth, and investors have the opportunity, if they wish, to follow their money. And so working closely with companies and providing additional funding, we believe, is vital in reducing investment risk, which certainly to an extent has resulted in just one partial failure since 2001 within our portfolio out of 34 investee companies. That, of course, is not to say that there won't be further failures, which is why, after all, investors benefit from such generous tax reliefs. But our belief is that by working closely with companies in a strategic and supportive capacity, that this goes a long way to mitigating the risks.
Lovely, thanks for that. And as I said, that's a sort of 20-year history, which kind of plays to the firm's kind of heritage and its investment experience. And the regulator, always reminds us, past performance is no guide to the future, and you quite rightly pointed that out. Now, let's obviously within the kind of EIS space and just broadly within the portfolio, technology is a strength, an investment strength area for the business, and also is kind of broader sort of financial services as well. How did you, as a business, kind of essentially decide those are the kind of couple of the kind of key sectors for you from an investment perspective?
So, well, as we know, tech has certainly accelerated during the pandemic and encompasses almost every part of our lives, and the sector is deeper and broader than it ever has been. From a subsector perspective, we're agnostic, and our portfolio companies span electric motors, fintech, insurtech, edtech, digital advertising, Internet of Things, software as a service, digital mapping, and cloud-enabled applications. In the same vein as some other fund managers I speak with, we're fortunate enough to be in a position whereby deal flow far exceeds the number of new investee companies that we are seeking, and we invest in less than 1% of the companies that approach us. A number of potential opportunities that come across our desk are introduced by people within our own network who are already familiar with our investment criteria, which helps filter relevant opportunities before they come across our desk. Potential companies that we meet must initially meet our investment criteria, such as the company must have achieved revenue of more than 1 million in the last 12 months. The company's strategy overall in sales and marketing strategy should be well developed to optimize growth. Typically, we like to lead the round and ultimately purchase an equity stake of between 20 and 40%, depending on the level of investment we're going in at. And as we follow our money, that stake will increase in subsequent investment rounds. The agreed valuation must naturally be realistic, of course, and a board seat available to us. The potential investment must be EIS qualifying and have HMRC advance assurance before any investment is made. And then the investment should be in the range of between 1 to 3 million, certainly for an initial raise.
Interesting. So, as you quite rightly say, that these are sort of businesses that are quite well through their kind of business cycle, aren't they? This is very much not early stage. These are businesses with proven revenue and sort of profits. And a couple of the areas within the technology space that you're invested in: EdTech, education technology; InsurTech, insurance technology. What is it about those particular areas that that you find appealing as a business?
Well, over the last few years, technology has disrupted every sector with an array of innovative products and solutions, and EdTech and InsurTech industries certainly no different. With regards to EdTech, according to the government, the UK has the largest EdTech sector in Europe, with unrivaled expertise in many areas such as AI, online education, and as a result, it's become a global hotspot for the EdTech industry. Over the past 5 years, UK schools have spent more than £1 billion on digital learning tools. In the US federal government is investing at around 8 times the normal rate in secondary education at the moment, with the HEROES Act alone delivering some $225 billion. So the pandemic has certainly been an accelerant for the uptake in EdTech across the UK, the States and beyond. As schools and universities embrace online learning, or have had to embrace online learning. And some commentators believe that the pandemic has compressed perhaps 3 years EdTech marketing into just a few months. Like any parent will acutely be aware, myself included, 2020 was the year in which millions of children were forced to leave the classroom and start learning online with parental support. And UK EdTech was there to support them and benefited from this unprecedented growth. On the InsurTech side, most traditional insurance companies don't use a lot of data to create their products. They rely on demographic information that is some 40 years old or even older, and they're struggling to price policies correctly, and many are missing out on huge financial opportunities. So there remains a really big opportunity for insurance companies to evolve and adapt to changing customer demographics and preferences. And we've seen digital transformation of the insurance industry accelerate again during the pandemic, and the growing success of UK insurtechs has been largely attributed to the creative ways they continue to address customers' insurance need in an increasingly digital economy. And this is enabling insurers to deliver innovative products that challenge the status quo of the incumbents, not just in personal and commercial insurance, but also in specialist markets as well.
Fascinating. They sound like two really dynamic sectors. Now, let's move on to the kind of the issue of sustainability. Obviously, we talk about it a lot more now as a sector. Is there a sustainability element to some of the investments? You've already mentioned the innovative electric motors, for example, which is one of the businesses you're involved in. Is that an element you were looking for as part of your investment sort of thesis?
Yeah, we don't look for sustainable company as such, but as part of our due diligence, we do absolutely expect companies to promote inclusivity and sustainability, and companies who are actively working at reducing or eliminating their carbon footprints. That said, as I mentioned earlier, and as you highlighted, one of our portfolio companies is very much in the sustainable space. And we first invested in Sciata Limited, the electric motors business, in July 2016. They produce ultra high efficiency, high power to weight ratio, compact, lightweight electric motors and controllers specifically designed to propel a broad range of vehicles, from motorbikes to cars, buses and trucks. and more recently have developed a marine engine to support decarbonisation and sustainable mobility on motorways. Having had an IPO back in July, 15th of July, this will be the next potential exit for investors in the fund when their 6-month lock-in comes to an end in January of next year.
Lovely. And actually that neatly sort of takes me on to, you've touched on it before, what is the sort of point in a business's life cycle that you make your first investment? And then how long do you typically tend to stay invested in a company?
So as I mentioned, we're growth stage investors, and that for us is companies that are post-revenue 1 million plus on an annualized basis. And this allows time for the product or service to establish commercial viability, contracts to be established, evidence of the effectiveness of go-to-market sales and marketing strategies, but just as, or even more importantly, allows a period of time for the team and senior management and the board to work together. You can have a great product or service, but if the team are not working cohesively together towards a common goal, then at best the company is not going to ultimately achieve its true potential. And so once we are invested, we may be working with a team for 5 to 6 years. And so the people element is absolutely critical. We consider exit opportunities before we invest and work with companies in identifying potential exit opportunities throughout our investment journey with them. And some of those opportunities may come from strategic introductions we make to them during the investment period. We aim to be invested in a company for 4 to 6 years, and historically our average holding period has been 4.5 years, although I well imagine we'll see the average creep out to nearer 5 to 6 years.
Interesting. And as you say, I guess when you make an investment, you can't have an absolutely definitive exit strategy in mind. Part of it is, how does a business evolve? And sometimes that might be a trade sale. Sometimes it might be an IPO, as you just mentioned in the context of the electric motor sort of business. So there's a flexibility required, I guess, is my question.
Yeah, of course. I mean, timing of any exit is down to commercially when is the right time to exit a business. When do opportunities present themselves? Sometimes we are approached by a strategic buyer interested in acquiring a business, but where we believe that that they haven't reached their full potential, so we can carry on growing that business and achieve a greater return on investment if we hold the investment for perhaps another year to 3 years, depending on where we are in the investment life cycle.
And when you're looking at a business and you're putting a valuation on it, what are the sort of metrics you're looking at to create a sort of fair value? And then follow on from that is, once you are invested, sort of how regularly do you revalue that investment?
Well, as I'm sure many fund managers would say, more often than not, an investee company believes that their company has a higher valuation compared to our own valuation exercise. And getting the valuation right to maximise growth for investors is critical. But two-way dialogue is important in ensuring the investee companies agrees with our own calculations. The valuation exercise is to an extent an art rather than a science, but a critical step in providing our investment committee with a balanced view on the current proposed level of funding. Specifically, the valuation methodology used will incorporate several different elements, including market comparables, discounted cash flow analysis at various rates, and recent transactions to form what we believe is a prudent and fair valuation for all parties. Once invested, we revalue companies on a quarterly basis. In general terms, we hold investments at the price of the most recent funding round. Absent a funding round in the last 3 months, each investee company's valuation is reviewed using BVCA guidelines.
Lovely. Thank you very much for that. That's really kind of helpful. I know a lot of advisors kind of, are keen to understand that kind of information so they can relate it back to their clients. Let's sort of two more questions really before we finish up. What do you sort of think the unique investment opportunity is that EIS, offers to advisors and their kind of clients? And again, now, why sort of at this point, perhaps in the cycle of growth investing, do you think is a great time to get invested?
Yeah, good question. I mean, we're certainly seeing growing interest in EIS investment with restrictions on annual pension contributions as investors look for complementary tax-efficient investment opportunities. And as we saw recently, or not so recently in the budget, that the income tax personal allowance and high rate threshold will be frozen from 6th of April 2022 until 5th of April 2026. And the capital gains tax annual exempt amount, pensions lifetime allowance, and the IHT and residence nil rate bands were also frozen at their current rates. And all of this comes on the back of sustained low interest rates for the time being and volatile markets. And so we anticipate increased demand from investors looking for tax-free, unmarket correlated growth afforded by EIS qualifying investments on top of the myriad of other tax reliefs that they receive.
Lovely. And sort of final question, what is it you think that makes sort of committed capital sort of stand out really, and would be kind of reasons why advisors should perhaps consider sort of placing some of their client money with you?
So demonstrable track record, transparency of deal flow, transparency of investee company due diligence, and the ability for investors, should they wish to do so, to follow their money once they're invested in any subsequent investment rounds into underlying investee companies, to avoid the potential for dilution later on down the road. In looking at any fund manager, relevant track record demonstrating successful exits, validating target returns for investors is certainly an area of due diligence that I think is important if we focus on the investment thesis rather than just on the tax relief alone. Our investment strategy has remained unchanged since 2001, and we've achieved an average 41% IRR and 2.6 times return on investment, excluding tax reliefs, which is in line with our target return of 25% IRR or 2 to 3 times return on investment. Transparency is also important to help advisors and investors with their due diligence, and we're very happy indeed to share examples of our investee company due diligence as part of this process. We also often have dialogue with advisors and investors as to the likely companies that will be invested in, and some investors like to invest on a purely discretionary basis, and there are some that like the fact that they are not necessarily investing into a blind fund and can gain an understanding at least of the companies that they will most likely be investing into. And then finally, we tend to, as I mentioned, we tend to be follow-on investors, and so investors have the opportunity to follow their money if they wish to do so in order to avoid dilution.
Excellent, Glenn. Thank you very much for your time. Obviously, anybody watching who would like more information about how Committed Capital invests and its EIS portfolio, you can go to the Committed Capital website, or of course, it's all available on the GrowthInvest platform. But for now, Glenn, thank you very much for joining me.
Thank you very much indeed for your time, Lawrence.